Hey guys, it's Ryan Now here. Welcome to the Average Show Investing channel. So, it has been a really great year for stock investors. Now, the year started off as if we were heading into a recession, but what do you know? The stock market has rebounded strongly and it is now rocketing to the moon. Well, if you're an American stock investor, if you're a Malaysian stock investor, it looks like it was taking off, but now it just seems like it's going to crash and burn again. So I suppose a question on many investors' mind, especially Malaysians and average Joe like me, is the Malaysian stock market still investable? Well, today I hope to answer that very question. But before we start, now just a side note, I'm just an average Joe in Malaysia trying to learn about investing. So this is not a recommendation to sell or buy any stocks. And it's always advised that you do your own due diligence and build up your own conviction. With that being said, let's get started. I'd just like to share about my strategy investing into Malaysian stock market. As we know, Malaysian stock market, when it comes to dividend, they are very, very generous. With that being said, so basically, I'm trying to find good, stable companies that have consistent, good and strong dividend payout ratio and payment. Okay, with that being said, let's get started. So basically, this is my whole Malaysian portfolio. You can see that the investment amount was 25,961.62. And the current market value as of 4th of September was 25,827.15, which gives me a total loss of 134.47. And the dividend collected up to 4th of September was 676.8 ringgit Malaysia. And the current dividend yield is 2.61%. So what I try to do is I hope that I can boost up the dividend yield to at least 5% or 6% annually. Okay, so the first company that I invested in is called Aeon Credit Service Malaysian Berhad. And it had a very good dividend payout ratio, 30.3% of profit after tax, which gives them a dividend yield of 4.38%. Now, this is a company that I have seen which goes from an easy payment scheme company to now issuing their own credit cards and having its e-wallet, integrating the entire Aeon ecosystem. Now, Aeon Credit has been a really good growth story. And looking at their financial receivables, you can see that their loan book is still growing strongly year over year. Having a good dividend payout ratio of 30.3%, it means that they have room to actually increase their dividends. Their dividend policy is not really consistent, but still I like the prospect of Aeon Credit, especially after it was awarded with the digital banking license, meaning now it has more products to offer to its customer in the future and integrating the whole Aeon ecosystem. And the next up is CCK Consolidated Holdings Berhad, with a dividend payout ratio of 34.5% of profit after tax and a current dividend yield of 4.17%. Well, CCK, the reason I bought into it is because this company actually engages in the rearing of poultry products, prawns, and seafood products. Ring a bell? Yep, these are the things that you might be commonly eating every day. So it's a consumer staples. And given the current environment, economic conditions, being essential products, I believe they are less susceptible to recession. And also compared to their peers, more well-known brands like QL Resource or Leong Hap, it has a much lower PE ratio, which means that it's cheaper and higher return on equity. That means their management is doing a more efficient job in allocating their capital. Also, I like the dividend payout ratio of 34.5%, which I think is very sustainable. And so I'm keeping it. And the third one is a company, where the activity that they're involved in is something that we enjoy on a Friday night or over a weekend with a bunch of friends. That's right. It's Carlsberg Brewery, Malaysia Berhad. So Carlsberg has a dividend payout ratio of 85% of profit after tax, which means that almost all of their profit have been given out as dividend. And in fact, Carlsberg has done that before for quite a while. in the past before the whole lockdown and COVID-19 happened, and which gives them a current dividend yield of 4.38%. Now, I believe that Carlsberg Brewery can be classified as another consumer staple. And the reason I bought into it was I thought I got a good discount during the hung parliament after the GE15. But no, the share price has fallen much further since due to inflationary pressure, which means that they have higher raw material prices. But still, I'm confident that the stock will recover. Recession or not, most people would still like that pint of beer. At least for me. Reason why I chose Carlsberg over Heineken is because it's more diversified, as a Singapore, Sri Lanka exposure aside from Malaysia. Fourth, Formosa Prosonic Industry Berhad. Dividend payout ratio of 51% of profit after tax and a current dividend yield of 7.84%. What can I say? This company has been my favorite to add into given the current headwinds faced by tech companies. Formosa is a company that designs, manufactures, and markets speaker systems. Yes, when you're watching Netflix and chill, Netflix with your girlfriend, and that speaker, probably it was designed by Formosa. Simple reason I like this stock because it has a growing dividend since 2014. Also, there's not much analyst coverage, which means that this company might be under the radar for many institution investors and retails alike, which can be seen from their much lower PE ratio compared to their EMS peers like PI, SLP, VS. Don't ask me why all these EMS likes using weird alphabets. But despite that, despite a much better ROE and much higher dividend yield of 7.84%, the company is in a very strong net cash position, and I believe that it can weather through this economic storm and rebound strongly once the economy recovers. And then the fifth one is, of course, our Malaysian Daikor, Malayan Banking Berhad, which has a dividend payout ratio of 40 to 60% of profit after tax and give a current dividend yield of 6.34%. Well, I guess we don't need much introduction, right? Because they are the Malaysian Daikor and they have been roaring back this year. Yeah, I wanted to do that. I believe that banks tend to benefit, especially from a higher income earned from interest. So no need much explanation. Malaysian Daikor has been a very consistent and stable dividend payer. And six is Syarikat Takaful Malaysia Keluarga Berhad, with a dividend payout ratio of 35% and current dividend yield of 3.65%. Actually, I must admit, I didn't really do much research on this company, and I just went into it because I thought that, the underpenetration of the insurance or takaful among the Malaysia community will provide a very huge runway of growth. But, at the time, I didn't really understand much about how the insurance industry work. I didn't realize how the insurance industry is very competitive and commoditized. Perhaps if you want to learn more about the insurance business, I can recommend you going through Warren Buffett's letters to shareholders. And dividend payment has not been very attractive either, at a mere 3.6%, which means that it's actually worse than some of the FD out there. So worth a deeper dive to determine whether it is still a keeper or loser. And last but not least is another of our Malaysian Dailo, which is Tenaga Nasional, with a dividend payout ratio of 40 to 60% of profit after tax and give a current dividend yield of 4.64%. The reason why I like Tenaga is I know they haven't been efficiently run, but they are the monopoly in Malaysia, especially when it comes to utility like electricity. And Tenaga has also been a very stable and predictable dividend income payer. And what I especially like about Tenaga is that every once in a while, they actually give out special dividend payout to reward its shareholders, which means that although the current dividend yield is 4.64%, there might be a chance that it may boost it up to 8%. So basically, that's all for my Malaysian portfolio. So the verdict, whether Malaysian stock market is investable? Well, I suppose it's really up to what your mindset is. And yeah, for me, it is still investable. And we'll see in 5 years' time whether I will what, or I will land on the moon, or whether I will crash and burn. If you like the content thus far, remember to click like, share, and comment down below. And of course, I really hope you subscribe to the channel so that it can motivate me to make more of this content to share it with you guys. See ya!